Okay.
All right, welcome everybody. Thanks for joining our webinar today. Um, Today we have Brian Kennel, who he will be our speaker for the day. He is the CEO and founder of Performlaw. It's a consulting firm that dedicated to help law firms become market aware, fiercely competitive. Brian has been doing this for 30 years. He has tons of experience working with law firms throughout the US. And he helps law firm leaders plan, develop, analyze, and improve their firms. Brian specializes in areas such as partner and associate compensation, strategic planning, financial management, lateral evaluations, new partner admittance, and profitability, which is something that we're going to talk about today. Brian's a great leader, great person, and I'm very excited to have him present to us today, give us a little bit of his knowledge. And with that, Brian, I'll hand it off to you and take it away.
All right. Thank you. Good morning, everyone, or afternoon, depending upon where you are. But today, we're going to kind of do an overview of sort of how does the business of law work. And for most of you on this call, you probably have some sensibility about all of this, but it helps to sort of lay a foundation and then increase the complexity as we go. And so the other thing I'd want to say is if you have a question, just drop it in the chat and we'll get those addressed too. Why don't we just go ahead and jump into this? So all law firms have basic financial statements, and since this presentation is sponsored by an information management company, the data that you get out of your financial statements should be all the same in most law firms. Is typically, though, some do it well, some don't. But let's talk about what the basics are. So in the law firm income statement, most firms understand this. We always get into sort of a discussion with law firms. There's almost, it seems like at one point their financial systems evolved from the checkbook approach, which is where the partners ask, the accountants how much money's in the bank. And if there's a lot of money in the bank, things are good. If there's not a lot of money in the bank, things are bad. And that's as far as it goes. And so I'm always surprised by, how firms really still run off that sort of basic standard, which I guess it makes sense on some levels, but there's obviously more to it. But the income statement, when I explain this to partners, is really simple. It's cash in the door, fees collected, because, law firms are overwhelmingly cash basis in their accounting, less the expenses, which are the employee costs, facilities, practice support, practice development, marketing, professional development, G&A, and then net income. Net income is an interesting number in a lot of law firms because of the way equity owners sometimes categorize their earnings. If they put their base earnings or guaranteed payments or even salaries, and the way some of them are organized above the line, it's going to drop their margin down. When comparing to a firm, for example, it's like an LLC and everything comes out below the line. So we define net income as what the equity owners split ultimately. And I don't care how they get it, what they get. When we go through these processes, we always take out everything the equity owners get, regardless of how they're organized, drop that below the bottom line, and then start doing the comparisons, because that's going to give us a common number. So every law firm needs to have income statements. We just talked about that, balance sheets, which are just, assets and liabilities and equities. Nobody really spends a lot of time on those. I mean, the key things on the balance sheet really are, cash, debt, how much you owe the bank, how much cash you have in the bank, and how much the partners are owed in their capital accounts is pretty much all anybody really cares about. Capital accounts is an area that most attorneys really don't fully appreciate or understand what that means, but really it's the equity owner's share of the firm's worth. And without getting too deep into it, maybe later in the presentation, an equity owner's capital account on the financial statements might say, for example, $200,000, but because the accounts receivable and the work in progress are not on the financial statement in a cash basis balance sheet, typically, then a big piece of the value of the firm is not necessarily shown on their equity account or in their equity account. So that's always a confusing sort of process when we get into transition planning and things like that, and we're trying to value the firm. General ledgers, sometimes you will see partners ask for general ledgers, but maybe 2% of the time, which is just the detailed list of all the transactions. If they have a real-time system and they have a user ID and they learn some basics, they can just go in and look at the transactions, um, you know, you know, like that. But in other systems where they don't have access to that stuff, they got to ask for it as a report. And then just subledgers, which are like accounts payable, trust accounts, accounts receivable, things like that. So you got to have that. And then your basic books and records, your balance sheets, your capital accounts, and your ledgers. I kind of covered this already, but I'll just kind of organize them for you here. And this kind of thing you can just hand to the partners in the firm. And if you're an attorney, this is the kind of thing you can look at and say, hey, we ought to be getting this as a minimum out of the accounting department and out of our system. And this is what these things basically do. So, each category is listed, assets, liabilities, equity, and then what are the attributes or characteristics of those. Same with the capital accounts, same with the common ledgers. Now, capital accounts, again, they seem to be challenging and, just as a concept, but they're increased by your share of the net income or any other gains the firm had. They're decreased by the monthly draws, profit distributions, and any other payments or losses. And so, and then whatever's invested, income decreases, amount invested in the firm. So as we pull out income from, for example, then the amount invested in the firm is less because we're taking the money out and giving it to the partners. And then you have your common ledgers, which I mentioned earlier. So this kind of the foundation for the rest of this is just at a minimum. I don't care how complex your system is. I don't care how big your law firm is, how small your law firm is. You need this foundation. This is where it all starts and ends. So let's get into something a little bit more useful as far as making money. And so it's pretty clear how law firms make money, right? You work hours, you bill those hours times a rate that begets a value. Maybe you don't bill all of that to the client, so you realize about 98% of that typically, and then the clients always clip you for a little bit on the back end, so that brings you down to about 97. So effectively, you're collecting 95% of every dollar you bill. I mean, it's a typical example. So just in terms of how you think about things, when somebody says collected realization, that's really just the comparative of what the hour was worth when you put it in and the cash you got in the door. And what happens in between is not as relevant. I mean, those are KPIs and things you can do to try to improve ultimately that collected realization. But in the end, you spend collected realization. So let's talk about just timekeeper profits and how to put together a good sort of timekeeper profitability. So what are typically, we get a lot of engagements or a lot of people calling us up saying, look, we're trying to calculate overhead per lawyer, and we're a little bit stuck on that, and we don't know how to do that, or we don't exactly know what's a direct cost or an overhead cost or an indirect cost. So let me see if I can clear some of that up real quick. Direct costs are timekeeper salary and benefits, and then any other specifically allocated costs. So if somebody has, for example, a secretary, and that secretary is assigned to that timekeeper, and all or in part, then that is a direct cost that gets allocated to that timekeeper. And then overhead is what's also described in some firms as indirect costs. It's really just overhead, which is facilities, practice support, practice development, professional development, and G&A, general and administrative. Now, some firms will go in and say, look, we want to allocate directly marketing costs to each originator or to each lawyer. And so some of those practice development costs do become direct costs, but but typically they're just lumped in the overhead. And so you take the total cost per lawyer. Let's say you're paying an attorney $125,000 a year. You have 15% benefit costs. That gives you total, and that's an estimate. You can put the actual benefit costs in. A lot of firms just say, look, use 15 or 20%. That's close enough for what we're trying to do. Others get really precise with this and go to their payroll system and add up everything that somebody gets in a benefit. So anyway, in this example, total payroll cost $143,750. Let's assume you have a secretary that you're paying $65 a year. Depends on what market you're in. Secretarial salaries are up significantly. This could be 75 now. Benefit costs typically run around 20% at the lower compensation levels. So the total secretary cost is 78,000. Let's say I have a third of that secretary if I'm this lawyer that we're looking at here. So you just take a third of that cost and you allocate it. So you have total direct costs then of 143,750 plus 25,997, which give you a direct cost of 169. And then let's just assume everything else averages out to about 100,000. So my break even, so these would be these allocated costs. This 100,000 would be the overhead, your share of the overhead costs. Now, what I would tell you on allocating overhead to lawyers is we've seen it done several different ways, but the most popular ways are to just allocate all lawyers' indirect costs or overhead costs evenly. So if you're and you adjust it for how long they've been with the firm. So if I've been there half a year, I get half of a full share. But basically, we take our total costs, we subtract, the direct cost for the payroll and the benefits, and then we divide everything else evenly among the lawyer timekeepers. Others have a graduated method. We like this method better, where partners get a full share, associates get less than a full share, and paralegals get less than that. Okay. And there's all kinds of reasons that go a little beyond this, and we may get into it in a little bit if we have time, but there's all kinds of reasons why you do that. But it's really important that you have a lot of transparency around this, because, if you're using a comp plan, for example, that rewards people for profitability, then they get really concerned about a lot of these things, and they're going to want to know how this allocated overhead is calculated. They generally understand their salary and benefits, usually never have a problem with that, and they understand, if there's a secretarial cost or some other direct cost, that's pretty transparent. They may argue as to whether or not they actually use a third of that person or half of that person or all of that person, but those are kind of around the margins of that. They generally understand the direct cost. It's the indirect or overhead costs that are just challenging for a lot of these systems. So it's really good to have a policy on that and to be really clear about how you're allocating that. So if you were just looking at this lawyer, for example, let's say we had collections of 380,000. We had direct costs of 169, and we had overhead of 100. This person would generate $110,000 profit. Now, some firms bonus off of that. Some firms just set a target, and because they want everybody to be over 100,000 in profit. You can use this in a lot of different ways. So that's kind of an example of how you would, break down a typical timekeeper profit. The timekeeper profit's easy. Client profit, matter profit is a little more challenging, because you got to get into costing out each individual hour. But that said, this is kind of again, now we're building off of, so you've got your basic building blocks, your financial statements we talked about up to this point. Now we can use that data to calculate timekeeper profit. Now you have basically financial statements, and then now you've gotten those financial statements broken into which timekeepers are profitable. So the next thing in terms of budgeting and planning is you got to start to think about capacity and planning. So you can build these hours. And so this was a nice small firm because it fit really well into one slide and it didn't have to be confusing, but it doesn't take, this could just be a section, for example, if you're a larger firm. And so essentially you start out with, listing out the folks, partners, income partners, you call them non-equities, whatever you want to call them, but, those kinds of partners, associates, paralegals, and totals. And I just say for a bit of context, most of this is going to be applicable to defense firms, hourly oriented or even flat fee oriented. You still can bring it back to hours and make some sense of it as far as measuring productivity. So just say that just someone on here is a plaintiff firm or a contingent fee firm or even a flat fee firm, you have to adjust these models to account for that. And so you would have, without getting into it too deeply, you would have maybe, dollars through the doors, cases settled and other metrics like that, other metrics like that to manage. But capacity analysis, I think, is good for either kind of firm, because basically all you're doing is you're taking the practice. This is basically a plan hours distribution, practice plan hours, and you say, whether you're working on hourly work or non-hour or non-hourly work, you still only have so many hours to sell every year. So let's say, for example, the section heads were putting in 2,400 scheduled hours, and what scheduled hours are just the total hours you're going to dedicate to your career. Okay. Now, again, for this, what these are based on is just our observations over the years about what the average equity partner, for example, dedicates to their career, both billable and non-billable. Okay. And so, again, this is just sort of a sample of what you'd like to try to get. In the post-COVID environment, I would just add that it's very difficult to get this kind of a commitment ultimately to the practice. But the ones who still do this and the ones who are doing this in terms of the top line scheduled hours, total hours allocated to practice, they're still doing really, really well. And I think the less you put into it, the less you get out of it. So for a lot of these firms that are calling us and they're struggling a little bit and they don't feel like they're competing as well, a lot of times you look at it and people just aren't putting in the effort they used to put in. Now, I would say that, and then I would say this: the balance between billable and non-billable hours in terms of schedule, there's more flexibility there. Okay, so for example, you might look at a section head who's got 2,400 total hours they're dedicating to the practice, and only 1,600 of those 1,639 are billable because they're doing so much other non-billable stuff. So you literally have some flexibility between what's billable and non-billable, remembering that billable hours primarily, or even case-related hours, if you're on a flat fee or alternative fee model, even a plaintiff model, the more time you spend on the cases, I mean, those are the revenue generators. So you can't just have everybody doing non-billable contributions, be that as they may. At some point, you got to generate some money. So you balance these out, and this is kind of a good comparative or a good mix of sort of suggestions. But you do it your own way, and then you get down here and you say, okay, well, what makes up this 761 hours of non-billable time? And then so in this, and I won't go through every one of these, because you can read it for yourself and you get the idea. Let's say they spend 2 hours, 3 hours a day on admin. I mean, figure 266 hours is really only about an hour a day on, administrative type stuff. And that could mean timesheets, billing, and stuff like that. It adds up quick on a full year. It's like, what, 252 work days or something. So that's not much more than an hour a day. And then you have skill development, bar professional. This would be non-marketing, pro bono, recruiting, and then training. So let's say this person, as a model, is putting in 461 non-billable hours, and then throwing 300 into marketing. That's how you get to the 761. Now, we actually have firms that do what's called a practice plan, and they sit down with all of their people and they kind of map out the year as a plan. Things change, how plans are, but they set this up, and then they have their capacity analysis, and this capacity analysis informs your budget and your projections every year, because you're saying, look, we're, in this, for example, in this section, if you want to call this a section, or if it were a small firm, you'd say, look, we're going to do about 10,000, 10,000, 11,000 billable hours this year. Then you can start to work from there. So that's a pretty key document. And so now you getting into a little bit of this discussion in a law firm of building value versus contributing income. I alluded to it before. If you spend all your time building value, then you have a hard time manifesting that value in the income, because nobody's spending any time, working the cases. So there's got to be a balance in these things. But building long-term value in terms of how you contribute, how you compensate somebody now, generally has more salary emphasis and less bonus emphasis, but it also has equal advancement weight. And here's what that means. If I have a lawyer and they're building skill sets, and they're building relationships and long-term kind of benefits, their ability to make income, to generate income on a go-forward basis is stronger, because they have more skills, more valuable skills. And so you would kind of look at, like, if you're going to compensate someone here, you would kind of look at that as more about salary and less about just generating cash. If for example, moving into the next grid here, is if I'm just contributing to profit, and I say that, and I don't mean I just say that for emphasis. If I'm solely focused on contributing profit, even if I'm doing a very simple thing, and I'm doing it over and over and over again because we got lots of it, and I'm generating a lot of hours, and the firm's billing and collecting those hours and making a profit, then I should get paid for that. But if that particular thing goes away, then there isn't any more of that work, and then I have to retool, and I'm not really as valuable as someone who's built a more rounded career, as the thinking goes here, or skill set rather. So in that sense, you would say, well, look, if you contribute to profits, that's a year over year thing. So that's going to not necessarily be in your salary, but that's going to be in your bonus. And we're going to certainly look at it as a criteria for advancement, because no one's going to turn away from hard work, and recognizing hard work. So again, these are two aspects of how you think about contributing value to a law firm. So what are the attributes of long-term value? Quality of professional work, obviously doing great work, that's job one. Client relationships and service, we'll get into some like KPIs and stuff around that eventually here. Personal development, business development competence, not so much business development success, because in some of these firms, especially institutional firms, bringing in a client isn't as easy as supporting the firm brand and supporting, just the overall effort to bring in business as part of a team, rather than, hey, I walled this thing off, this is my client and I got to get credit for it. And then you have, of course, the originations and all that other stuff that you start to fight about. And training contributions are huge, becoming even more important in the world we're in now. Professional recognition and, obviously firm reputation. So if you add to the firm reputation, and then there's contributing to profit. So if you're starting to think about, there's like building value and long-term value and adding to the value of the firm. And then there's the other reality, sort of more reality-based side, that at least in the short run, and that is what I'm doing to contribute cash now. And if you have the contribute cash now side completely out of balance with the building value side, you run into a problem where you have a bunch of folks just focused on the short run and very little gets done for long-term firm health. So it's just something to keep in mind when you're planning you're starting to plan your year or your 1-3-5, meaning 1 year, 3 year, 5 year type planning. And then you have contributions to profits to finish off this slide, which is personal profitability, client profitability, how much profit you're generating through your leverage and supervision, the Do you bring in, can you recruit profitable lawyers? It's a huge contribution. It's not typically viewed like that in a law firm. It's typically viewed as, oh, that was great. You got somebody, and sometimes you'll get a bonus for that. But when you really stop and think about it, if everybody is excited and brings people into the firm and they're profitable, that's really a sort of the gift that keeps on giving. It just, that money just keeps coming. And then training contributions, which is related to profitability of others. I mean, if you're training people, that's a huge value to the firm, and it's an objective value. I mean, if you can increase somebody else's profitability or 15 or 20%, it's an objective value. So again, won't go through this whole thing. I just want to point to you. This is just a little guide that you can use, for your experience from 1 to 4, 5 to 8, 9 to 13, and 14 plus. This is a little guide that we put together for kind of where you ought to be spending your time and how many hours you ought to be contributing to the practice. Again, this was admittedly done. This chart was done, probably 2019, 2020-ish, and I'm loath to update it, because if we update it, I mean, I think we're going to start to think about baking in some of this mediocrity. And while it is, especially, for example, in insurance defense practices and things like that, getting more and more difficult to get billable hour, to get eight billable hours in a day, for example. You might have to work 12, where maybe you could get 8 in past, 5 years ago, 8 years ago, by only working, 9 hours a day. There was always some slippage there. It is getting more difficult to capture hours, not so much as a technical thing. I mean, you can capture the time you spend, but it is getting more challenging, convincing clients that time you spent was worth what you billed for it. And so, and especially now with generative AI working its way onto the scene and the potential that might have, the disruption in a chart like this figures to be significant, at least within the categories. You may have this huge shift to training. You may have this huge shift to training others. I'm already seeing a huge shift to supervising others. So, you might see some flexibility in a chart like this, but I still think it's valid, and I think each firm ought to put this together as part of their economic model and rely on it. So I give it to you here as a model. And if you go to our website at performula.com, you can actually download a template for that. All right, let's talk a little about compensation. So there's lots of ways to do it, but this would be the typical equity member approaches, formula-based. Everybody has kind of probably seen this at some point. Question is, can you pull it all together into something that is an incentive rather than a disincentive, and you can balance the positive behaviors against the sort of the consequences or negative behaviors that come out of these sometimes. But gross fee credits or profit splits, collected origination dollars, that's obviously at the top. So you can get origination credit. You can get origination credit in most formula-based systems because you developed the client and you were able to claim the origination credit for it, or somebody shares something with you. And sometimes in formula-based systems that work off of gross fees collected, typically, some work off profit. If you have a system and you generate client matter profitability, then you should work off profit rather than gross, because it's a better approximation of efficiency, and it's a better, fairer approach to the sort of situation that happens in a lot of law firms where one particular partner or section or group has really high gross, but also has high overhead to go with it, and they're treated maybe based on their gross in a comp formula rather than what their actual contribution to profit is. So if you can get to profitability in these systems, you can fix that. Maybe billing attorney dollars, working attorney dollars, those all get into these formulas in some way. A lot of times firms will just combine billing attorney and origination and the billing attorney dollars are just sort of a fee split or a origination split rather than a billing attorney. But you can see them in here. You can see billing attorney in systems a lot. Another characteristic is compensation is not tied to ownership percent. So by nature, a formula-based system doesn't typically tie compensation, or certainly not the majority of the compensation, to what you own in the firm. And then, so for example, profit pools can be split based on, different sort of incentives you're trying to build on. And maybe ownership is only 10% of the profit gets split evenly, or based on ownership would typically be evenly. So here's just a little example here. And then the other one is just percent of ownership. Typically, you will find these percent of ownership systems outside of what you might say is a sort of a lockstep system in a really big firm. But typically, these percent of ownership systems are smaller to small, mid-sized type firms where they try to approximate your contribution to your ownership percent. And then there's, of course, always a hybrid. It wouldn't be a law firm without hybrids. So that would be some formula-based objective portion with subjective and equity pools. So, and typically those are done in tiers. So that's another component of how you build a healthy law firm. Now, what's a financial performance factor? Business hygiene, that's your billings, your collections, your timesheets, just how you run your book and how you run your book from a business perspective. So is your business hygiene, that's a factor. Obviously getting new clients, managing other timekeepers, managing the client relationship, working files. Those are all factors that you can create KPIs on and you can gauge on a financial performance basis. So a business hygiene, for example, is, what percentage of your files are outstanding over 120 days is one KPI, and that could have a financial consequence or incentive attached to it. And then your subjective criteria, again, this whole wealth creation. Again, in any planning system or in any system in a law firm, if you don't only tie compensation and incentives to it, it's typically going to get ignored. I mean, that's just sort of the fact of life. So, and a lot of firms actually have sort of their strategic plan, but then their compensation incentives actually work against that. So you have to align these things. And I think aligning them is to first define them. You define what it is, then you align them. So this is an attempt to help you do that. So these wealth creation factors and sub-factors, you can you can read through these yourself, but the broader categories are recruiting, branding and marketing, cultural development, systems and intellectual property, and attorney training and development. So, and then there's these sort of factors that go into that. And whenever you can get, this is what's really kind of cool. And, and for us, we sort of specialize this. And for people who do this, like we do, you're always looking for the killer KPI, the one key performance indicator that can really, kind of like your blood pressure, I guess, if you're in the medical field, it's like, what's the one critical KPI that you should be watching? And if you can sort of create attributes off of sort of major functional or operational objectives, then you can start to create KPIs and you can start to define it. So this give you a little head start on that. Okay, management and investing. So one thing about another aspect of what you have to recognize in the sort of business of law is that you have to understand there's two components that relate to money that are commonly ignored or overlooked, or at least taken into account, but more on an abstract basis. And that is managing partner and key committee services is always a challenge between, do we actually have a formula for compensating the managing partner or someone who sits on a key committee based on what that committee does or what that committee accomplishes or how well that managing partner performs? Is there any kind of accountability there? And then is there any kind of, direct compensation and incentive there? It's a very difficult aspect of all of this. And a lot of firms don't necessarily do this very well. So you'll have people that the downside of it is the managing partner a lot of times feels unappreciated and feels as though, um, that it's, it's more of a sacrifice, and they're putting themselves at risk in the comp system because, they don't have good objective numbers because they're running the firm. So that's always challenging. And then people who sit on key committees, if they don't feel good about, their service on those committees is going to get rewarded, they don't do as good a job. They just don't have the incentive to do it. And then ultimately, there's equity. And so and this is the hard one. So let's say we're all in this firm, and I have 100,000 in the firm, and you have 100,000 in the firm, but maybe you generate, I don't know, $1 million a year, and I generate $500,000 a year. Well, yeah, definitely, you're going to make more money than I do. But at the same time, for a part of that, we're kind of equal in that. I have my capital at risk. You have your capital at risk. We should at least get an investment return on that capital. And so that's something to consider. And most firms just don't go that far. So, the other sort of ultimate thing you have to decide, and I wasn't really necessarily going to get into too deeply, but I'll go ahead and do it because we're doing really well on time, and this will be really helpful for you because, um, you know, and that's admitting new partners. And so, because it's going to help you think a lot. It's going to help you think if you think about if someone sat down and you said, "Look, do you want to be an equity partner?" And somebody said, "Well, why would I want to be an equity partner?" Yeah, you have to be able to answer that question. And good future equity partners are good for your firm. So the benefits of partnership equity, are that you get to participate in the leverage profit. Depending upon how the formula works, you may only get to participate in a little piece of leverage profit because most of it's going back to the originator. But you're supposed to be able to participate in that. You're supposed to be able to keep more of your own profit. You remember that timekeeper profit in the very beginning of the presentation. You might remember that that profit, let's say, was 110 or 125,000. Well, that's this leverage profit, right? That's what people at the partnership table are keeping. So ultimately, what happens when you become an equity partner, or someone becomes it, they get to keep more of that, and obviously can market better. And then if you're doing it right, you have self-determination. So if you're sitting there thinking about, okay, I got to answer this for our associates, and they ask me what the benefits of partnership equity are, you need to go through this checklist and see if you can check any of these off. Okay, because if you really can't check any of these off, what you start to notice is what everybody used to think was rare, that's kind of common now, and that is, I'm not sure I want to be an equity partner. I'm not sure there's any real benefit in it to me to be an equity partner. So some firms have chosen to deal with that by saying, well, we'll just have a fairly limited number of equity partners. We'll give everybody sort of an employment contract, if you will, and a comp plan, and then we'll just own it. And we'll take 10 or 15% off the top, and hopefully we can be competitive that way and people won't leave. So, but in a lot of firms, it's kind of a serious problem if people don't ultimately want to aspire to be equity partners, because it does dictate a limited life cycle for the firm. If you don't have a vibrant group of younger, newer partners who are motivated to become equity partners, eventually you're just going to flame out. So it's just something to consider in terms of your planning. So I'm going to just send these slides because I wanted to leave time for question and answers. But I will tell you what's the rest of this really is, and this again was it's optional content. You can have this, but it's benefits of equity partnership. It's main ways to admit new partners. So you can kind of go through that. Again, if you go to our website, there's lots of written materials on this and things like that. And it will give you the characteristics of admitting new partners and things like that. And so it's pretty detailed. It's pretty solid. We do it all the time. We do it in terms of helping first generation firms become second generation firms. when first generation firms typically have a struggle to become a second generation firm. If they become a second generation firm and they're successful, then it's a lot easier. So anyway, that's everything. And then there's just this sort of benefits analysis of whether you go W-2 versus K-1 if you're a member. So that I think is the end of kind of this segment. That puts us right at about 11, almost at 11:45, which is where I wanted to end. And now I think we can open up for questions, and maybe I can elaborate since we have a little bit of time left. I can elaborate on any or all of it.
Any questions? Feel free to type them on the chat, and then I'll have Brian answer your questions. And then Brian, if you want to stop sharing your screen.
Okay.
Any questions? I did have a question, Brian, just curious. Can you give an example? You mentioned that your planning, if your planning is not aligned with the incentives, then it's doomed to fail.
Yeah, I
Can you give an example
see,
of firms that you've seen do that and how their plan has really not worked because their incentives were not
yeah.
aligned?
I think it's honestly more that scenario happens than they, because what typically is that the planning process a lot of times is kind of this theoretical process where everybody gets in a room and they talk about the things that they want to do and everything else, but then typically, just doesn't implement. It's almost like we've decided this and it sits there on the corner of the desk and it's inert, but nothing happens. And then, or they, so they haven't taken that next step to say, okay, if we want to incent people to take this plan seriously in the firm, we have to change what we value and we have to communicate how we value, or we at least have to explain to people in our current system, if they follow this plan, why it'll be better for them. And I think that's where it falls down. It's a written document. Everybody gets it. Everybody kind of gets the idea, but nobody really sort of does anything with it because they're not really sure what it means to them, because most lawyers tend to, my experiences, look at what's sort of the work in front of them, the clients they have, and the stuff that they have to get done every day. And anything else is a kind of optional and additional work. And when you're really, really busy anyway, and somebody's asking you to do optional additional work, you want to know you want to know why,
Yeah.
And so I think they don't do a good enough job of explaining the why. Other times, they say, well, look, we need to be more team oriented. We need to, we need to put the best people on the files as they come through the door and not be so worried about, who originated it. And this way we won't have originators who aren't as qualified to do the work, doing work simply because if they give it to Deanna, for example, to do it, then she's going to want to claim credit for it. And you get into that whole mess. Well, that's going to derail your plan.
Yeah, absolutely. We have a couple more questions coming in.
Okay.
What strategies do you employ and find successful in socializing and generating buy-in within the firm for making changes to the compensation structures, new software decisions, etc.?
Yeah, I think that's a good question. So the sort of the best practices on that are to start with transparency. So you build the plan, whatever it is. So let's say we want to change the comp plan. Okay. Before you even get started on trying to change the comp plan, the first thing you do is you put out just a document, a statement, however your firm runs, that says, look, we think the current comp plan could, and you don't really just, I wouldn't express it the other way than this. I always like to express it in terms of the benefits of the pain. Okay. So you put out a document that says, look, we want to propose some changes to the comp plan because we think we can do better for the following reasons with different incentives. Okay. And so you do that. Okay. Then of course you have the other side of the coin where people are going to come back. Well, if you do that, it's going to be negative in this other way. And so you're like, you take all that input, you let everybody feel like they're part of that process. Okay. Then you find the common ground. And if you just a little bit of common ground, you can start to build on that. And so, in terms of socializing it or getting people on board, it's more about the why, why you want to change it, expressed in terms of benefits to changing it. Not the one part of that process that always seems to derail is when one or two people are like, yeah, we're producing all the work around here and we think we're underpaid is probably not the best way to go about that, because it feels more like a power play. Like, we're doing all the work and we're not getting paid enough, and damn it, things are going to change. That usually doesn't do it. It's a much better way to have just say that same thing or do that same thing is to say, let's clearly define the values what's valuable to us and why. And then let's do a fair evaluation. And if you go at it like that, and then you talk about the benefits of people doing those things, then I think you can get started. So again, it's all about explaining the benefits of the pain.
Perfect. We have one last question. It says, what kind of profitability level should be used? Equity partner only, or one that encompasses all timekeepers, associates, paralegal, etc.?
I think that question relates to transparency. So I think I can answer it two ways. One, I would calculate profitability on everything. It's all part of the same system. You can take it right on down to the paralegal. The second part of that question is like, what do you do with it and who should see it? Okay. The clearly the equity partners have a right, technically have a right to see everything. Some firms are a little more autocratic than that, but let's just keep it simple for now. So equity partners kind of have, the administrator rights if you're in a system, a computer system or something. The whether you show an associate their profitability or not cuts both ways. One way it cuts is that it's complete transparency. The associates can appreciate that on a level, because they're like, okay, I see how this works, and I see that I'm not profitable, or I could be more profitable. And so it could be a motivator in that sense, because now they understand you're not just making it up. What a lot of firms fear on that is that, well, once the associate knows how much money we're making on them, they're going to want more of it. Okay. So it's like, man, why do we show them it? Because now that they've seen it, they're going to want more of it. And I always say this, that my default position on that was to be more transparent, because whatever information you don't give them, it's just information they're going to make up. And so you typically will run into an associate and they'll say, look, I generated, 1,800 billable hours. I know you charge, $200 an hour for me. So that was $360,000. I only made $120,000. You kept the rest. It's like, well, no, there's overhead. And they're like, yeah, you kept the rest. So they have this idea that their profitability is like $200,000 or 200, because they just look at what you pay them. So I just think it's better to educate them early on, and teach them how, if you stop and think about it, I do understand there is some downsides to it. Now, some firms might nuance that a little bit by saying, okay, we'll do it, but we're only going to do it for people we think that are going to stay. So anybody who's been here 3 years or longer, we'll start to share with them. We don't really necessarily want to share with somebody who might only be here for a year. Again, that's all around the margins on that kind of stuff. I think if you have a culture of transparency, you're better off, because you're really not going to be successful, with sort of hiding it from them. They're just going to make it up, and half the times they make it up, it's wrong, and that's even worse than showing it to them.
Yes. Think we have any more questions? So,
Okay.
thank you, Brian. This was great, very informative, really good feedback on the deck, and we'll be sending that out. I'll send out the recording, and then Brian will send me the deck, and I'll send it along as well.
Okay.
Yeah, really good feedback throughout, and Good stuff.
Well, everybody
So
have a
there's one
great day.
question before you go. Do mid-market firms need to keep up with trends in big law regarding special bonuses, etc.? Also, how can firms tie these bonuses to performance, specifically in the context of firms shifting away from hourly billing structures?
Yeah, that's a great question. All right, so how do you keep up with the big firms? You depending upon like where you are and how you know what you really can't. I mean, it's a different model, and so can you can you maybe borrow a concept from them, like say, okay, mid-year bonuses, for example, if you're a firm that does bonuses at the end of the year, maybe you switch to quarterly or mid-year bonus. So structurally, you've sort of matched the way they're doing it. So you can do that, and everything is relative. And the other thing, you kind of have to confront a little bit on this is for most small and mid-sized firms, if their people could work for big law, and realistically speaking, like now we're talking about in the money centers, New York, Dallas, places like that, they would, they would. The money would just be too strong. Not everybody can work in big law. So I'm not sure that you have to match the gaudy numbers, obviously, that they have, and because you may lose a person or two to that if they really want to compete at that level. They're working probably a lot more hours there. So I would just say you might emulate that structure, and I've done that quite a bit in the last few years, and that seems to work. I think people kind of appreciate a little bit of money along the way. So that's one thing. What was the second part of that question? Um, I think I lost your audio there.
Sorry.
Yeah,
How can firms tie these bonuses to performance, specifically in the context of firms shifting away from hourly billing
yeah,
structures?
yeah. Well, the easiest way obviously is in cash generated, but you could also do other KPIs like if you're going to flat fee, for example, you could shift it to let's say because we're working on one of these right now. It's a timely question where there are three or four. Let's just say you break a case into five segments if you're starting to think about this, and you say for segment one, let's just say I'm going to pick something really simple, right? But it's how many because this is a deliverable based comp system now. So let's say in these cases, there's always I don't know, and I'm not an attorney, so but you got to use your imagination over here. Let's say it's preparation of interrogatories and completion of the discovery phase. How many of those they do on an interval? So how many how many x how many discovery requests do you get out? And again, that's kind of all going to be a little bit automated, but you can just think of it in your own cases. How many requests get out in a defined time period? So how many things what did you get done rather than how long you spent on it? If you shift gears, this is what you're going to have to do, and this is the important part of that. You're going to have to shift gears to start to think about tasks completed and deliverables delivered. So tasks completed and deliverables as the metric rather than billable hours. I don't care how much time you spend on it. I care how much of it you got, how many deliverables, for example, yeah, pick whatever one you want in your cases that you got out in a specific time period. And I'm going to start to compensate based on outcome oriented metrics rather than the time you spent doing it. Matter of fact, the less time you spent doing it and the more efficient you become, and especially with AI and things like that, the more efficient you become. I'm actually going to pay you more for less hours because your output, because the client's ultimately only going to pay for a deliverable in the future, right? So if I break the cases into phase one, two, and three, and let's say I pay you phase one is X dollars, many of those phase ones as we can get in a month. It's just like ours. It's just how many phase ones can we finish in a month or a year or whatever the interval is. That's the way it's going to be. So it's going to shift from hours oriented to task oriented, deliverable oriented compensation, and then you should be fine. That's how we're doing it. Matter of fact, if you go, there's a article on our website that breaks down how to do this. Say on a when you're working on cases, and the pieces and parts of cases. There's some data out there for that gives you an idea where we go with that.
Great. Thanks, Brian. So Perform Law, it's the website, it's on the chat. And yeah, we appreciate your time. And like I said,
Great.
this will
Thank
be
you.
sent out. We appreciate everybody's time. Thank you so much for coming.
Have a great day, everyone. Bye-bye.
Bye.